Welcome to the Deep Dive. We're diving straight into a really significant moment in the world of digital assets today. Bitcoin just smashed past its previous all-time high. We saw across an incredible $120,000 on Coinbase this week. And, this isn't just another number hitting the ticker. It feels like a clear signal of some, profound shifts underway, shifts in how we perceive and maybe interact with digital currencies. So our mission for this deep dive is pretty clear. We want to unpack exactly what pushed Bitcoin to this new peak, why now, and crucially, what does this all mean for the future of digital assets? And maybe most importantly, what it might mean for you. We'll look at the forces driving this rally, the big regulatory moves happening down in Washington, D.C., how Bitcoin's utility is changing, moving beyond just, digital gold, and what the experts and maybe even the general market buzz are predicting for 2025 and beyond.
Yeah, and what's really fascinating, as you said, is the timing. This new peak isn't happening in a vacuum. It lines up perfectly with this pivotal crypto week that's going on in Washington, D.C. right now. It really suggests this powerful convergence, market momentum, meeting policy focus. It's a really compelling time to dig in.
Okay, so let's unpack this incredible milestone first. July 14th, Bitcoin officially hits a new all-time high, $120,000 on Coinbase. It even touched, $120,700 for a moment?
Just over $120,700.
That's a 13% rally this month alone. Its third straight green monthly candle. I mean, that's quite a performance.
It truly is. And when we dig into the why, what's really fueling this, several key things pop out from the sources we looked at. Probably the biggest game changer, you really can't overstate it, was the approval of those spot Bitcoin ETFs earlier in 2024.
Right. That seemed to open the floodgates for a lot of investors.
Exactly. It just massively expanded access. And Bitcoin's value jumped, over 50% in just a few months after that? Look at BlackRock's IBIT fund. It hit a record $83 billion in assets under management, AUM. But the really astonishing part isn't just the number, it's the speed. It tripled in just 200 trading days.
Wow. 200 days. How does that compare to, say, traditional assets?
Put it this way. The main gold ETF, GLD, took over 15 years to get to a similar level of AUM.
15 years versus 200 days.
Yeah. It just underscores this unprecedented institutional appetite and maybe, a fundamental shift in how quickly new asset classes can gain traction now.
Okay, so ETFs are huge. What else?
Then there's the 2024 halving. For anyone less familiar, this is basically a built-in supply cut. It happens roughly every 4 years, programmed into Bitcoin's CUD. And historically, these halvings, like back in 2016 and 2020, they came right before these huge price jumps, over 300% in the following year.
So it's a known supply shock that tends to push prices up.
Pretty reliably, yes. And layered on top of that is just this broader wave of institutional adoption. Major asset managers, big brokerages, they're now offering crypto strategies. It's becoming mainstream. We're seeing over 30% of all Bitcoin now held by exchanges, ETFs, public companies, even some governments.
And what about just general market mood, sentiment?
That plays a role too, absolutely. Yeah. Can't overlook positive sentiment and the macro picture. Bitcoin, despite its volatility, often trades kind of like other risk assets. It rallies when investors feel optimistic. Ryan Lee over at Bidget Research pointed to those strong ETF inflows we mentioned, but also a shift in corporate treasuries holding Bitcoin. And even, interestingly, some positive sentiment apparently coming from the Trump campaign's signals.
Okay, so pulling back then, you have the ETFs, the halving supply squeeze, big institutions jumping in, and generally positive vibes. How does all this really change Bitcoin's place in the bigger financial picture, not just for Wall Street, but maybe for, someone listening to this?
Well, it fundamentally shifts the narrative, doesn't it?
Right.
It means Bitcoin isn't just this, niche speculative thing anymore. It's rapidly becoming a recognized part, maybe even an integrated part of the global financial landscape. It's attracting way more capital, way more serious attention than ever before. That institutional validation is key.
Okay, so that's the market side. But as you mentioned, this is happening right as Washington focuses in. This crypto week, July 14th to 18th, 2025, the House is discussing 3 pretty high-profile pieces of digital assets legislation. That sounds like a big deal.
It is a big deal. These are potentially landmark bills. First, you've got the Digital Asset Market Clarity Act. the Clarity Act. That one aims to set up a sort of comprehensive regulatory framework for crypto overall.
Okay, like the basic rules of the road.
Exactly. Then there's the Guiding and Establishing National Innovation for U.S. Stablecoins Act. Thankfully, they shortened that to the Genius Act.
Huh, yeah, much better.
Right. This one's laser-focused on creating the first federal framework specifically for payment stablecoins. And just quickly, stablecoins, they're cryptos designed to hold a stable value, usually pegged to something like the U.S. dollar. Think Tether, USD coin.
Got it. So regulating those specifically. And the third one.
The third is the Anti-CBDC Surveillance State Act. This one aims to block the U.S. from issuing its own retail central bank digital currency, a digital dollar. The core argument there is about safeguarding financial privacy.
And the overall goal, I read, is pretty ambitious, making America the crypto capital of the world. That seems like quite a shift, especially considering President Trump's previous skepticism in his first term. Now it's described as pro-crypto.
It is a remarkable turnaround, politically speaking. And it's not just happening in the U.S. These moves have global ripple effects. The U.K. is talking about its own draft crypto rules. The EU's big MiCA regulation went fully into effect last December. Observers like Tom Duff Gordon from Coinbase said the U.S. administration's approach seems, quote, nothing chaotic, suggesting it's deliberate. And Lord Ed Vaizey in the UK thinks the U.S. will essentially make the weather for everyone else on crypto regulation, set the global standard.
That's a really important point about setting the global tone. But let's bring it back to the individual. How might these specific bills, like the Genius Act for stablecoins or the debate around a digital dollar, actually affect how an average person might use digital currencies, or even impact their privacy?
That's a great question. It really gets to the heart of practical use. The Genius Act, for example, if it creates clear rules for stablecoins, that could make them much more reliable, maybe easier to use for everyday things, like potentially simpler cross-border payments, maybe even just buying stuff online without the wild swings of other cryptos.
So more stability, more trust for everyday use.
Potentially, yes. And on the flip side, that Anti-CBDC Act and the whole digital dollar debate, that's directly about privacy. The big concern is whether a government-run digital currency could allow too much tracking of your spending. The bill aims to stop that specific type of CBDC from being created. So yeah, these aren't just abstract laws. They could really shape how digital money works for you pretty soon.
Fascinating stuff. Okay, so moving beyond price and regulation, there's this other, maybe quieter revolution happening. It was a big theme at the Bitcoin 2025 conference in Vegas. Bitcoin transforming from just a passive store of value, like digital gold, into an active financial instrument. What does that actually mean?
That's a really critical shift. And it's where this whole decentralized finance or DeFi movement built on top of Bitcoin comes in. The argument is that Bitcoin isn't just for holding. Its network, its infrastructure can be used for much more. It's the bedrock of finance, as proponents say. You have projects like Lombard Finance, for instance. They let users stake their Bitcoin to earn yield. Then they can use those yield-bearing tokens in other DeFi applications, lending, trading, things like that, often on other blockchains, but secured by Bitcoin value.
Okay, so making your Bitcoin work for you, basically.
Exactly. And others, like Rootstock Labs, are building Layer 2 solutions. Think of them like express lanes built on top of Bitcoin. These allow for smart contracts and more complex financial applications, aiming for financial inclusion, all running on Bitcoin's secure base.
And the benefits they're aiming for.
The core idea is building a trustless, permissionless financial system. What that translates to is, hopefully, better borrowing rates because you cut out the middleman, more available liquidity, lower fees, potentially greater privacy compared to traditional banks. And it all ties back to that core Bitcoin idea. Self-sovereignty, self-custody. You control your assets directly. That's the, quote, bedrock of Bitcoin DeFi.
Do we see this happening in the real world yet?
Yeah, there are some powerful examples, like in places such as Argentina, where local currency inflation is a huge problem. People there are reportedly using dollar-backed stablecoins, which are themselves collateralized by Bitcoin, to basically escape that currency erosion. It's a way for individuals to protect their savings when the traditional system is failing them. That's a pretty profound use case.
That really does go beyond just investment, doesn't it? It's like a financial escape hatch.
Yeah.
So summing that up, how is Bitcoin offering these practical tools that genuinely empower users, give them more control?
Well, fundamentally, by enabling direct P2P, peer-to-peer financial services, you don't necessarily need a bank as the intermediary to lend or borrow. You can potentially do it directly on the Bitcoin network or these layers built on it. That can mean faster transactions, maybe lower costs because there's less overhead, and potentially more privacy because you're not dealing with a big central institution for everything. It's about disintermediation, giving individuals more agency.
Okay, so we have this incredible momentum, the price surge, the regulatory spotlight, this expanding utility with DeFi, which brings us to the $1 million or maybe $150,000 question. Where does Bitcoin go from here? Ryan Lee at Bidget thinks it might average around $125K in Q3, watching levels like $108,500, $130,000. What else are people saying?
Yeah, the predictions are definitely all over the map, which tells you something about the market's uncertainty, right? Current sentiment measured by that crypto fear and greed index is sitting at 70. That usually signals things are getting a bit overheated.
Right, people getting maybe too excited.
Could be. But interestingly, other on-chain metrics, like one called long-term holder net unrealized profit loss, they're not yet in that historically overheated zone, which some analysts say hints there might be room for higher prices still. Network activity is up, but without signs of panic selling, which is generally seen as positive.
And the big banks and investment firms, what are their targets?
They vary widely, too. Standard Chartered, for instance, is still sticking to a target of $250,000 sometime in 2025.
$250K, wow.
Yeah. And then you have someone like Cathie Wood from ARK Invest, who's famously bullish, projecting $1.5 million by 2030.
Okay, that's ambitious.
Very. But then you have JP Morgan warning that maybe there's too much concentration in the ETFs now. They worry that could actually increase volatility and might cap prices unless some new major catalyst comes along.
Interesting counterpoint. What about like general online buzz? What are everyday traders thinking?
If you look at places like Reddit, like their crypto markets forum, you see that whole spectrum reflected. Some are relatively conservative, thinking maybe $120K to $140K. Others are aiming for $200, give or take $20K by maybe October 2025. And then you get the really optimistic calls, like $300K to $500, often tied to speculation like, what if the U.S. government starts buying Bitcoin for its reserves?
Right, lots of what ifs.
Definitely. And you can clearly see those psychological levels mattering. $100K was a big one. Now $125K, $150K seem to be the next mental hurdles.
So let's tackle that $150,000 mark directly. Is that a reasonable target for 2025? What does the analysis say?
Forbes looked into this, and their take was basically challenging but achievable. Getting to 150K would put Bitcoin's total market cap near $3 trillion. They point out that it wouldn't even take that much the world's investment portfolio shifting, like a 2% global allocation to Bitcoin could theoretically get it there.
But achievable doesn't mean easy, right?
Not at all. And this is the crucial thing to remember. The path likely won't be a smooth, straight line up. History shows these big Bitcoin bull runs often have significant mid-cycle corrections, drawdowns of maybe 30–40% before they continue higher. So expect bumps.
Okay, that's a really important reality check, which leads us to portfolio strategy, especially for you, the listener. Bitcoin has delivered these, frankly, eye-popping returns sometimes, but always with extreme volatility. Drawdowns of 50%, even 80% have happened.
Multiple times. Yeah, it behaves much more like a sort of volatile, high beta tech stock than a classic safe haven asset like gold, despite the digital gold narrative. Financial advisors consistently preach caution. They advise against just jumping in because you saw a headline.
So no FOMO investing.
Definitely not. The standard advice is a disciplined, patient approach. Maybe start small or invest gradually over time, dollar cost averaging. For most people's overall portfolios, Bitcoin is usually considered a speculative satellite allocation, meaning a small part, maybe 1% to 5%, depending heavily on your individual risk tolerance and financial situation.
And communication is key, I gather.
Absolutely. Good advisors really stress talking proactively with their clients, especially during these boom times. Sharing that historical context about the booms and the busts helps manage expectations. It ensures any decision to invest in crypto is based on a thought-out strategy, not just emotion or hype.
That makes a lot of sense. It's easy to get caught up in the excitement. How do you personally think about balancing that potential upside with managing the very real risk involved? It's a constant tightrope walk. Now, as we're thinking about all these predictions in market psychology, it's pretty fascinating how technology itself is trying to get a handle on this super volatile market. There's new research exploring really innovative ways to forecast crypto prices.
That's right. There was a recent study out of Monash University looking at predicting crypto prices using user sentiments combined with quantitative data. They pointed out that traditional forecasting models often just don't work well with crypto because it's so volatile. And interestingly, they found that crypto users tend to rely more on social media discussions, Twitter, Reddit, etc., than traditional news sources for their info.
So they tried to factor that social buzz in.
Exactly. Their approach combined sentiment analysis, basically measuring the mood in user-generated content, or UGC, online, with the hard market data, like price and volume. And the findings were quite illuminating. Sentiment alone, not a great predictor, weak correlation, but when they combined sentiment with trading volume data, the accuracy went up significantly.
Interesting. So volume confirms or denies the sentiment signal.
Something like that. And they found certain types of machine learning models were particularly good at this. Specifically, GRU's gated recurrent units. These are a type of neural network good at processing sequences like time series data. They're good because they can sort of remember recent events and forget older ones, which is crucial for crypto, because crypto prices often react quickly to, sudden news or shifts in online mood.
And how far ahead could these models predict?
They found the sweet spot was predicting prices about 17 to 24 hours in advance, which led them to speculate. Maybe the global market reacts slower despite the volatile nature, or perhaps investors are just patient or slow reactors to what's bubbling up on social media.
Bit of lag.
Seems like it. They also noted predictions were most accurate during the afternoon UTC time window, which lines up with peak U.S. trading hours and, probably not coincidentally, peak Twitter activity.
Wow. So if we connect that back to the bigger picture, it really highlights how human behavior, collective mood, the flow of information on social media, it's all becoming quantifiable, measurable inputs for financial markets now. It's not just about the fundamentals anymore, it's about the crowd. Okay, so we've covered a lot of ground today. We navigated Bitcoin's recent surge past $120,000. We explored the potentially groundbreaking crypto week regulations being discussed in Washington, looked at how Bitcoin's actual usefulness is expanding through things like DeFi, and even peeked into the cutting-edge science trying to predict its next move using social sentiment.
Yeah, it really underscores a key theme. While the short-term price swings, the volatility, that remains very real in digital assets, the longer-term trend seems to be pointing towards increasing mainstream acceptance, integration, and importantly, real-world utility. It's this constant interplay of market forces, evolving rules, and ongoing tech innovation that keeps shaping this space so rapidly.
So what does this all mean for you as someone learning about or navigating this exciting and, let's be honest, often confusing space? Perhaps the real deep dive isn't just about absorbing the data or chasing the latest prediction. Maybe it's more about honing your own critical thinking, learning how to separate the genuine signal, the real opportunities, from all the surrounding noise and hype. Keep exploring, keep asking questions, and maybe even keep an eye on those social media sentiments, but understand how they might be moving the market and why. Until next time, stay curious.